All right, good day everyone. Welcome back to another episode of Spark Your Fire. I'm your host David Shih, and as always, got smiling John on the other side of the camera with me. Good to have you back, John. What's been happening?
Hey there, David. Hi there, listeners. Just fighting the good fight out there in the market and trying to get good deals for the clients.
Sydney
Yeah.
has Sydney market slowed down recently? Just out of curiosity,
Uh,
what are you
yeah.
seeing?
It certainly it slowed down at late last year actually. So Q4 was quite flat. I actually think it's starting to pick up a little bit.
Okay.
We've had some pretty high auction volume numbers and clearance rates around 74%. Um, when I speak to agents, the like I did this morning, agents tend to describe a market that's a little bit softer than the data suggests, so that there aren't as many buyers around. And I know in my own circumstances, there's just not that much urgency to sort of fully get into it. So the clearance rates are good, the volumes are high. The data suggests there's a lot of buyers, but actually on the ground, I don't think there's a lot of buyer conviction at the moment, and I think there's a bit of wait to see. Obviously, the interest rate increase changed sentiment a little bit, but I don't think it's rocked the boat too much. I think it's like sobered the market up a little bit, but the demand, the conviction was quite flimsy last year as well. The market rose. There were good buy numbers. There are still good buy numbers, but I just think there's a little bit of conviction that's come out of the market on the
Yeah,
buys.
yeah,
Yeah.
yeah. I think it's going to be a very diversified market. I mean,
Yep.
Sydney is a huge market, and we're talking about markets within markets here.
Mm.
So anything that's kind of below the 1.5 mil is basically the main battlefield at the moment, right?
Yes.
Because that's going to be supported by the 5% deposit scheme that the government is backing for at the moment. So that's where majority of that competition is. I reckon that kind of segment is still pretty competitive and still got a lot of demand because that's where the affordability range is as well.
Correct. Yeah, it's very
And
crowded
then
there. It's crowded up
exactly.
to about 800,000 as well because there are first home buyer schemes up to there as
Mm,
well. 1.5
mm.
million is another mark. And then, yeah, but I mean, they're hard markets I mean, you don't get a lot of property for those budgets in Sydney.
No.
But there are still pockets of value then, and we're encouraging our buyers to go into those markets.
Yeah, no, 100%. Yeah, so I think that's going to be a few different speed tier markets from here, I guess, as normally do. It's not a one single rising market, we should say.
Yeah,
There will be segments that's basically slowing down. There will be segments that's still kind of going rapidly, and there will be segments where it will start to come back a little
yeah.
bit as well. So, it's just I guess Sydney market's doing what it typically does. So
Yeah, look, I think Sydney prices, which were flat to slightly softer at the end of last year, I think they're flat to slightly higher this year. I think we'll see, probably less than 0.5% growth at that sort of thing.
yeah,
I actually think there's a lot of more action in the rental market at the moment. I think there's a bit more kind of
rent's
demand
been
on that
going
side.
up. Yeah, yeah.
And I think a lot of the buyer action is up in Brisbane, which is a market I don't have anything to do with. Definitely Brisbane is very strong at the moment. So.
Yeah, no,
Favorite
100%.
for investors.
Yeah, yeah. So that's why, yeah, investors are still looking into state at the moment, but just not quite Sydney, as a matter of fact. But
Yeah.
yeah, we'll see.
But look, the
Um,
market's a piano accordion. You've got a buy, it goes in and it goes out, and it sort of gathers energy and then it releases that energy. So ultimately, you go where the wealth and the population is, and those markets will prevail. But Sydney hasn't been as we were discussing before the podcast started. Sydney hasn't been like the premier kind of performing market for at least 5 years. I think 2021 might have been the last year, and before that, I can't remember. So, solid market growth that whole time, but
yeah.
certainly underperforming these other markets that are catching up.
Mm,
Yeah,
exactly. So it all comes down to, I think, affordability side of things at the end of the day, right? Like the affordable markets will probably continue to perform, whilst the high end of the market, which Sydney has got a lot of premium areas and a lot of very expensive houses, those areas will probably continue to just go stagnant a lot more.
correct.
Because I think what everyone's kind of now expecting rates higher for longer. as well, and there could be potentially another
Yeah.
one this year.
Well, I
I'm seeing
mean,
it.
yeah, look, inflation numbers in the US, the UK, Europe, they're all coming out softer. So
Mm.
Australia is definitely an outlier that we still have some inflationary bias. I wouldn't be surprised if we were cutting by the end of the year. I just don't think I'd be surprised if the economy was as inflationary as it is. The Aussie dollar is much stronger now. That's deflationary for imports. We'll see. We'll see. I don't think the economy is very strong. That doesn't mean you can't have inflation, but I wouldn't be surprised if we are cutting towards the end of the year.
Well, you hear here first from
Yeah,
economist John
first.
Comino. Expect rate cuts towards the end of the
Yeah,
year. Well, okay,
we'll see.
that
We'll
change
see.
that change is just like when depending on what you want to wear tomorrow,
Exactly. That's right.
as all
I
the
reserve the
economists
right
do.
to change my mind. Yeah.
But US, I think is Jerome Powell's term almost coming up to finish, coming up
Correct.
to expiry. Is that right?
Yeah, it's like May or
And
something is his last month. Yeah.
And the new Fed chair apparently is heavily geared more towards rate cutting. Is that right? Or
Well, that's not his record. So I forget the chap's name, starts with W, but he was very like critical of the stimulus under the Ben Bernanke years
yeah,
uh,
interesting.
this sort of constant pump priming of the economy that occurred sort of in the pre-Trump years.
Mm,
Trump sort of always been putting undue pressure to try to bring that back, but no, he's a like a dollar hawk, I suppose you'd say. It's
okay.
wanting a stronger dollar. Trump wants a weaker dollar.
Yep.
And he's been very anti sort of stimulus. I say stimulus with the air quotes because stimulus is really just inflation by another name, like pumping inflation into the system. And so it was a surprising choice because Trump has been putting all this sorts of pressure on cuts and expansion and weaker dollar and all that sort of stuff. So yeah, it's a bit surprising, but we'll see. I mean, I think that the appointment of the Fed chair is a political appointment, not an economic appointment, and I'm sure a lot of conversations have been had that we will never be privy to. So we will. I'm sure that they know what the game plan is.
Having said that, though, I mean, how do you look at it? Because I know US could US get into a position where they wouldn't be able to afford to make those repayments, and that's why Trump's been pushing hard in terms of trying to inflate the debt out the way. But there's only so much that you can do to try to
Mm.
delay the repayments, and I think there's a couple of repayment that's upcoming this year or something that's kind of near its in term, if I'm not mistaken.
Yeah,
Sorry
yeah.
about this poor terminology there, but is there a chance that US could be leading up to a bit of bankruptcy type of situation with the US government if they can't afford to kind of continue to
Yeah.
print their way out,
Oh,
not inflate their way out?
bankruptcy is inevitable, but bankruptcy can look different and is different. So the US has declared bankruptcy several times, like when FDR took them off, confiscated the gold back in 1933, that was a bankruptcy. When they went off the gold standard in 1971, that was a bankruptcy. So because they were kind of massive dollar devaluations at the time, and they essentially the 1971 Nixon closed the gold window, and essentially he was saying we can't pay you back in gold, so we're not going to do that anymore. We're going to print the money and pay you back. So that they'll never declare bankruptcy in a traditional sense because they can always print the money. In contrast that to say a European country that doesn't control its currency, Germany or Greece or Portugal, they would declare bankruptcy, but the US will never need to because they control the printing presses. You're right in the sense about like passing these thresholds, these moments of all these points of no return. The big point that occurred recently is the interest on the US national debt is greater than the military budget. So
Yeah.
they're both about $1 trillion a year, and interest, which is an unproductive payment, rather than the military, which at least you get something for it, is now greater than that military budget. So yeah, these are markers of decline. Obviously, they're bad, but the reserve currency thing, and I know it's sort of implied in when we talk about the U.S. currency, the reserve the reserve currency. status of the US is actually not an economic status thing. I mean, they are the biggest economy, but they're not the biggest global trader. The China is does a lot more international trade than the US. What the reserve currency, um, what the reason they have the reserve currency is actually because they have the most the strongest military, the most capable military, and the military with the sort of broadest reach. That's what the US dollar hegemony is about. It's about power rather than about size. So, and I think all these things like, like the kidnapping in Venezuela and that sort of, I think that's all to reinforce, well, it's not the reason for it, but what I think it does is it reminds everyone how powerful the US is,
Yeah.
and reinforces the status of the US dollar.
Yeah,
Um,
right.
yeah,
Okay.
but I'm a schmuck in Sydney somewhere, so I don't, I don't know. Yeah, I mean, Trump has always said he wants a weaker dollar. He's quite happy that the US dollar's been weakening over the last 18 months. He's happy about
Indeed.
that.
Yes.
But he wants to maintain the US dollar standard, and that's why I think that's ultimately it's about soft and hard power, which the US still has unrivaled, really.
Yeah, interesting. Look, yeah, that's keep an eye on it. I think there will be quite a bit of developments
Yeah,
on the US side of things, that's for sure, which will have a certain impact to the Australian economy and certainly the AUDs and if Fed cuts more rates along with the rest of the world,
yeah,
I don't see how RBA can continue to raise and go
yeah.
against the grain at this stage. So yeah.
Correct, correct. I mean, the RBA doesn't want a strong dollar either. I think that they weren't
Mm,
comfortable with it at 60 cents, but they don't want a strong dollar either. So, and they don't want to be swimming against the tide. Yeah, the Australian economy is not good, and now there's a lot of conversations about like closing the capital gains tax discount, which is really just an inflation adjustment.
mm.
We're being taxed to the wazoo. I mean, like if you're an alien and you were observing the Australian economy, you'd say, "Oh, you don't manufacture and your taxes are too high." I mean, like, um, yeah. So we've got our challenges. So
That's for sure. That's for sure. Different challenges for different people. So,
yeah.
all right. Okay. So for that, just a bit of a current affairs there, just to
Yes.
entertain our audiences. But
Yeah.
look, what we want to chat today really is about a months of inventory, or what we call an
Mm.
MOI indicator that John just came up with, by the way, not long ago.
That's not true.
I always crown it to you, John.
Yes. Yes. Fair enough.
But what it is for those people who doesn't have DSR, which is the data scoring system that usually that a lot of property investors use
Yeah.
in order to work out whether a suburb area is hot, not hot, is it balanced, that kind of things. Using the months of inventory or a bit of an MOI indicator can actually help you maybe coming in as a second opinion as well if you already have DSR coming in to see whether from a second view to say, are the data that we can collect online be able to help support the view that this is the suburb that you should be looking at investing. So
Yeah.
I thought today, John will take us through a little bit about the MOI because he's recently, got a client who's inquired about, should I be buying on these suburbs? What do you think about their long-term perspectives?
Mm.
So John's done a bit of homework and he's very kind to put it together and share with all of us in terms of the parameters that he's looked at. He's even utilized ChatGPT, welcome to 21st century as well. We've now got AI working hard for us. So, he has actually ran this data set or got most of these data sets out of ChatGPT. Um, and in order to come up with a reasonable conclusion, which he'll share with us. Now, by all means, John is going to caveat, and we're going to caveat any data that we have on here because the source is basically the output was coming from ChatGPT. So while we try to do our best in terms of making sure that that data is validated as accurate as possible, there could be mistakes. So treat it with a grain of salt. I think what you really want to understand and want to emphasize here is the methodology in terms of how John
Correct.
derives the data. Okay, so the methodology here is a lot more important than the output of the results. Okay, so I think I've blabbed on way too much. John, I'll hand it
No, I
over to
agree. I
you.
agree. No, thank you. It's a good intro. Yes, absolutely. So the question I received was, can I compare the demand and the supply ratios of three suburbs? And the three suburbs that we'll eventually get to are Bankstown, Cogra, and Hornsby. Complete why we would compare these suburbs, I don't know, but they are all at similar price points, and it's actually a very interesting exercise. But the DSR information, which is I think a lot more accurate than what we're going to go through, is behind a paywall. So what do you do if you want to understand the demand and supply of a suburb? So yeah, just in terms of caveats, this is data pulled a couple of months ago, so I think it was accurate-ish then. I actually think it's no longer accurate. So just take this as sort of an educational piece rather than relying on the data in this, and it'll obviously be a delay when this goes to air as well. So I'm going to share my screen and go through the concepts, and then we can discuss each slide as we go. All right. Okay, months of inventory. That's what we're going to talk about. So, months of inventory is essentially it's a lot. We talk a lot about days on market, but we never talk about months of inventory. And days on market is how many on average, how many days does a property kind of sit on the market? And a high and bad thing because it means it's kind of there aren't enough buyers to scoop up the supply, and a low number is good. Well, this is a very similar thing, months of inventory. And what it's saying is, how long does it take to sell a home? Um, but it's more like how long until all the current stock runs out. So to read it out, how long would it take to sell all of the homes currently on the market if no new homes were listed and the current sales pace continued? So it's a demand supply uh, perspective, and the formula is um, divide the number of listings by the average number of properties sold per month. So to give you an example, if there are 500 units in Hornsby on the market right now, but on average, there are 100 two-bedroom units sold per month on average. Well, it would take 5 months to clear all of the current stock, assuming no more stock comes on the market. The based on the average demand of 100 properties sold per month, they would all be cleared in 5 months. So the higher the number, the more supply there is than demand, and the lower the number, because you could clear all the numbers in 1 month, the higher the demand. So lower number is the shorter period of time, more demand. Higher number, they kind of language there. All right. David, before we move on to like examples and so on, what any thoughts on the formula, the methodology, the explanation of what it actually is, and how you understand it, perhaps?
Think it's very, very clear in terms of how you explained it. I guess in terms of the data set, how do you pull out the average number of properties sold in this instance? Do you get
Yeah.
that from ChatGPT? Do you get that from realestate.com.au?
So these examples come from ChatGPT, which is why I question the reliability. That's
Yep.
why we're
Okay.
talking in terms of concepts.
Yep.
But there are subscription softwares that I do
DSR.
have, that others may not have, where you
Mm.
can get this sort of data from. But there's lots of prop tech companies that do provide such data. But if you wanted to do it yourself, you would say how many, what was the average number of units sold in Cogra per month in 2025, and
Yep.
how many units are on the market at the moment. Now, the challenge, of course, is that ChatGPT doesn't know to switch on or off the include surrounding suburbs. And so you sometimes get very high numbers, but we're going to focus on the principle now.
Yeah. Okay. Well, look, I think it makes sense in terms of how you explain the MOI
Yeah.
data. So let's continue.
All right. So in a table, an interpretation of what it looks like. So if it takes less than 2 months of months of inventory, less than 2 months to clear all the current stock, that's a very hot seller's market. So the seller is very powerful, prices are rising. 2 to 4 months, this is considered a seller's market. And to be honest, that's kind of where we've been the last couple of years. We're in that 2 to 4 month. That's where kind of Sydney is in most markets. Moderate leverage for the seller's market. So 4 to 6 months is a balanced market. So it's stable. Prices are probably flat. I would say they might be dropping a little bit at that at 4 to 6 months. And then you go to the buyer's market. So this is where it takes a long time to clear the existing stock. There's a lot of stock, there's a lot of supply, a lot of sellers, and there isn't enough buyers to clear that. So 6 to 8 months of inventory is a buyer's market, a moderate buyer's market, and anything over 8 months on average to clear all of the existing stock would be a a serious buyer's market, a very slow buyer's market. Um, so that's kind of a way to think about it. As I said, like Sydney and most of the Australian market, because we do have fairly high population growth, we've got good demand all the time. I mean, interest rates aren't the only driver in terms of demand. We're always in this 2 to 4, and even sort of 2 to 3. If you ask chat, we're in that 2 to 3 uh, range for most kind of metro area um, suburbs in Sydney.
Is that
Yeah.
also partly due to the fact there's very, very little supply for the
Yes.
last couple of years? Very literally
Correct.
no new builds. And we're talking about units in specific areas
Yep.
across the board, like, so the housing accord which the Labor government has proposed, unfortunately, I don't think we even hit 60% at the moment in terms of the estimated number of completions, right?
Yep.
So we're way below in terms of the supply, and that's
Hmm.
what's one of the reasons what's causing the MOI indicator has been consistently kind of in between about 2 to 4.
Yep.
In Perth, I would say probably even more closer to the 0 to 2 because there's
Sure.
usually no
Yeah.
supplies there. So
Yeah. And look, there's also, I mean, it's a very broad, blunt kind of table here because the entry level properties have a lot more demand than the
correct.
high end and so on. They also have more supply of those sorts of properties, and so it's an interesting way to look at the market. Um, Now, I'm giving you a snippet of kind of how I explain the demand and supply ratio of the three suburbs that this particular prospect was asking about. And as I said, these numbers are very validated by data at the time, but I think they are too low, and I think these numbers have all gone up. And the reason why I think that these numbers are too low is because it was run at a time in December when there was no new stock coming on the market. So all the stock, doesn't get listed, let's say after the 7th of December, and all that remaining stock they wait for after Australia Day. And so there's this period of like the numerator in that formula before of stock listing is quite low at the time this was run. But because it's consistent across the three suburbs, it's okay because we're just comparing suburbs. And so this has got two-bedroom units, the demand supply or the months of inventory for Cogra, Bankstown, and Hornsby compared to Sydney in general. And then it's also got a bit of a trend analysis. So 2023, 24, and 25, which way is it going? And it's getting tighter and tighter across all of these markets from 23 through to 25. In all these markets, they are tight. So they're all 1.2 months to clear. Cogra, Bankstown is 1.2 months, and Hornsby had a little bit less demand than the other two, but also very tight at 1.3. Sydney as a market was between 2 to 3, let's say 2.5, which has been pretty stable. There was a bit of a increase in months in 2024, but it came back down again in 2025 when I think that there was I mean there's been low supply really. But what we can see here is that in these markets, and these are all like suburbs where there's a lot of development. These are all on important train stations, um, and these are all like well-known suburbs. They're not new areas; they're old areas. and they're all at about 1.2 to 1.3 months on the market. This is all what we would describe as a seller's market. This is what where prices are rising. And to give you an example of what a chart of Bankstown unit house prices look like since the 90s, but obviously through to the end of 2025, is that's what Bankstown looks like for unit prices over this period of time. Now, it's not all because of demand. Sometimes these charts get skewed by certain factors. So, for example, if there's a lot of new units, that would increase the average price of an area. So, if you go from sort of a glut of old units to a glut of new units, well, the average unit price of a brand new unit's higher. And the other thing that can skew this is the difference between 2 and 3 bedroom units. This is just for units, but if you've got a lot more 3 bedroom units, you get a lot of 3 bedroom units in Bankstown. That would increase
Maybe
the
increase.
average price. But nonetheless, that is what a chart of unit prices in Bankstown looks like. And we know from the previous slide that it's definitely a seller's market in Bankstown. So that's all I wanted to show you, actually. So, David, thoughts, comments?
Wonder with this chart, is it possible to cross-match in terms of the new developments or work out the new developments that has in Bankstown since in the last 2 to 3 years?
So,
Try to extrapolate that out.
discerning between like new units and old units and how they perform.
Like, say the new builds within Bankstown, are there a lot of new units that's been built in Bankstown in the last 2 to 3 years? And were they mostly three bedders that's been built or two
Oh,
bedders
right.
that's been built? In order to
I
work out
see.
whether
I'd
that
need
price
chat
spike
for that, and
is,
I'd need chat for that. Were the majority of units
yeah,
built in the last 3 years in Bankstown? Have they been 2 bedrooms or 3 units? I'd need chat for that, and I don't know how seriously I would take the answer either. I think that that would be a very unreliable answer.
just out of
Um,
curiosity, what did it come
yeah,
back with?
but look, this is where median prices are always a little bit
Mm,
dangerous because there's
mm,
a lot of things going on. But we can see that Bankstown has become a high demand area, and Sydney is a low supply market. I mean, for all of the population growth, for all the construction, there's just still not enough supply. And actually, supply problems are even greater at the moment than they
yeah,
were this time last year. So supply somehow is even lower than it was last year. And I remember you and I chatting about supply problems last year.
yeah.
Yeah.
And don't forget, Bankstown's gone up because of the metro.
Yep.
That's been in place as well. So I think
Correct.
this spike obviously had a number of indicators, not just purely based on the low supply. The considerations here will need to include the new infrastructure that's about to be put in place. So,
Yep.
the Bankstown line, which has been, I think it's been halted for at least 12 months now
Yep.
because of the new West Metro that's going to come through. So that obviously has pushed a lot more demand because people are saying, yes, we're going to be getting new metro. It's going to get us into the city a lot quicker. It's going to
Yep.
get linked all the way to Chatswood, Epping, Castle Hill, etc., all the way to Tallawong. So that obviously has an impact in terms of the price spike, and that's in Bankstown the last couple of years. And I was also wondering, the reason why I asked that was just because whether there was any more new Bankstown, new builds off the plan that's coming up, because off the plan we all know has tendency to skew the actual prices as well.
Yep.
So if there was an influx of new units that's been released in the last 2 to 3 years, then the MOI would not be the only indicator that you rely on. There will
Yep.
be other considerations that you would also need to
Correct.
consider to say that, okay, is this going to be impacting that? So maybe to a better degree, I don't know about, you'll know Coco better than me, but I would say from a Hornsby perspective, because I'm a local resident here, there certainly wasn't a lot of new builds at all. So,
Yes.
if we look at similar graphs of Hornsby, if there is a spike, then that would be purely based on a low supply and high demand. In
Correct.
other words, a lot more first-home buyers try to get into the market, into the
Yeah.
units market in there. So yeah, I think this Bankstown chart is probably a little bit skewed because there's a lot more other infrastructure elements that's coming into it,
Correct.
into that. But yeah, from memory, Hornsby wasn't giving that much of a spike, but it still had a bit of a slope, maybe a 45
Correct,
degree or
correct.
something.
So, ditto Cogra. It had
Okay.
that same spike. But look, these green bars are supply. We can see the green bar for if it might be 2025
Oh,
is
yes.
is is lower. So I mean, it's not an increase. It's not. There's no increase in supply. There's a reduction in supply, and so the reason for the higher prices is demand, which is, a function of the metro, the airport, and all these sorts of things,
Yeah.
and demographics and so on.
Okay.
Yeah. So, I mean, over this period of time, you would not expect to see a gentle downward trend in the supply from the late 90s in Bankstown, right?
Mm.
Why aren't there more? There are more properties. There are more people. Why aren't there more properties for sale? And it's a curious thing. I mean, it's probably the tax system. It's probably that it makes it that it's so expensive to sell, and that if you thought you'd made money, you'd probably give all of that back under certain CGT rules or whatever it is. Um, yeah. So maybe that's what it is. But irrespective of me pontificating about the reasons for lower supply, um, there is lower supply even in a market like Bankstown, even for units, which is bizarre.
Yeah,
Uh,
I know. A few years ago, I was like, there must be an oversupply and glut of new apartments that's coming
yeah,
in Bankstown, looking around 2015
yeah.
to about 2020 areas, if
Hmm.
I'm not mistaken, around during those period of time. Um,
And if you
yeah,
look at this bar compared to like 5 bars earlier, there's lower supply in 2025 than there was in 2021
yeah.
when there were lockdowns and there was only like 4 months of the market that was trading freely. I mean,
Mm.
it's a very strange chart actually. Uh, um, but
Uh,
what we're interested in today is the relationship between supply and demand, and
yeah,
we can see it 1.2 months of inventory, which is very, very tight.
yeah,
These are the sorts of returns you get. So now you asked a very good
okay.
question before we started the podcast. Is like what are some examples of parts of Sydney that have very high months of inventory? So where is there an
Yes.
oversupply,
Mm.
or where is there a buyer's market? And some of the suburbs that were mentioned, and again, validate this yourselves, dear listener. But some of the suburbs mentioned were Marsfield, um, uh, Miranda in the south. I think there were a couple of areas in the south.
Woolaware,
Carrabba
I think,
Point.
next to
Yeah,
Cronulla.
yes. Carrabba Point near Neutral Bay, and a couple of other places. So interesting that there are some places with much kind of opposite supply demand dynamics.
Yeah,
And for anyone local there, I mean that's obviously probably due to an increase in supply rather than a reduction in demand. But it also means it's a buyer's market, so you'd be buying into some softness if you were looking at those markets.
indeed.
Yeah,
Cool. No, thank you. Thanks, John. That's really good. And I certainly think that this methodology can apply to anyone who's looking to try to get a bit of a supply and demand ratio
yeah,
without obviously paying big subscription fees for the likes of DSR, Price Finder, or that kind of things. So it's a good indicator, I guess, to for your own experimental fun things if you're a bit data driven like that, and you can the good thing is with combining with the likes of ChatGPT now or the Google Gemini, you can get these data fairly quickly as opposed to having to go through charts and charts and charts of yourself
yeah,
all the way. You can get them to do the summation fairly easy, right, to be able to reach that conclusion. So take advantage of this technology that we have now. And I actually think, John, this two unit better type of comparison is quite well because I actually do think that units in Sydney is we're likely to be primed for some good times moving
yes,
forward.
I totally
So,
agree.
so that there will be some catch up with Sydney units to be done in the next few years. Now that the houses pretty much slow down, townhouses, villas obviously done or still doing their bit, but units wouldn't be too far
Yeah,
off afterwards. So, that gap is just too big to be ignored.
yeah.
So yeah,
Look, I
so
totally
one
agree.
to watch.
When I say this, there is a real opportunity in older units that
That's right.
the house to unit ratio is way too big.
Mm.
Houses are superior assets. There's no doubt about that. But there are moments in time where units are just relatively cheap compared to houses, but also compared to history. I mean, units haven't done a great deal in terms of capital appreciation since about 2017, which was kind of the previous peak, and they've gone sideways ever since. So that was 9 years ago. That was 9 years ago. So I would say that the most underloved part of the market, where there's probably the best um, kind of fundamentals, I'd say, are older units. Don't buy newer off the plan,
Yeah.
but older units.
The older units on a big block of land, small number
Yeah,
of lots, the ones
yeah,
that's got high land component or high land content. Basically, those would be pretty much at replacement cost, if not even.
totally. Yeah,
So, that's why we can't see, you can't go wrong with those,
yeah.
essentially. And as a bonus, if it's near any kind of TOD corridors, then there could be a chance that the developers could be snatching up at some point in time and
Yes,
replace it with a high density type of dwelling later down the track. So,
yes.
that would be an added bonus, but don't know.
Yes, you did say something interesting in there. I know we need to wrap, but you mentioned these are selling at replacement value.
Hmm.
Absolutely, that is quite true. There's to sort of paraphrase Tom Panos, who's a prominent Sydney real estate expert or Australian real estate expert and auctioneer. He says that we don't have a housing crisis, we have a construction crisis. So what's actually the big problem is it's so expensive to build, to bring new supply online, and once you fix the production problem, the building problem, how house prices will come down. Now, that ties nicely into two-bedroom units, three-bedroom units in old red brick or blonde brick walk-ups are selling at replacement value. That's a problem, that replacement value is so high.
Yeah.
But nonetheless, the economics of it make a lot of sense. So
Yeah,
thank you, Tom.
absolutely. Good one. All right. Thanks, John. Anything
Cool.
else you want to add to the MOI indicator that we discussed earlier today? No?
No. The only thing I would add is the MOI. Uh, it's not gospel truth. It's a little bit less reliable. It's coming out of chat, GPT. You can get different answers on different days you ask it the same question. So just go with some healthy skepticism when you're running the numbers. I think it's a very interesting indicative statistic, but I wouldn't hang my hat on it.
Yep.
But in the absence of, the supply demand ratio behind the paywall is better data. It's better.
Yep.
But in the absence of that, this is very useful directional information.
Yeah. Good points of wisdom. Thank you, John. Appreciate your sharing as always. And to our listeners, if you got any questions, feel free to reach out to us. You can
Yep.
definitely email us. We always put the email in the link in the show notes. But otherwise, have a great week, and we'll see you guys in another episode of Spark Your Fire. Thanks, John and David.